If the thought of investing in the stock market scares you, you're not alone. Individuals with very limited experience in stock investing are terrified by horror stories of the average investor losing half of their portfolio value. But don't worry, we are here to help you. Today we will tell you, what is the stock market and how does it work? What is the stock market? The stock market is a public venue for the buying and selling of listed company shares and exchange-traded funds, or ETFs. It's not a single market, but rather a network of stock exchanges around the world. Famous examples of stock exchanges include the New York Stock Exchange, that's NYSE, London Stock Exchange, LSE, and the NASDAQ. A nation's stock market is widely used as a benchmark for its economic health. Analysts use indices to track the performance of a specific group of stocks on an exchange. For example, the FTSE 100 represents the performance of the top 100 companies on the LSE by market capitalization. How does the stock market work? The stock market works by enabling buyers and sellers to negotiate their own prices for assets in a regulated forum. Buyers enter bids for shares in companies, and sellers issue an ask price for their assets. Once a bid price equals the ask, a trade occurs. Historically, stock markets were physical locations known as pits. However, most trades now take place via electronic trading platforms, which display the best bid and ask prices available at the current moment. The difference between buy and sell prices is called the bid-ask spread. A narrow bid-ask spread indicates liquidity in the market, while a wider bid-ask spread indicates low trader activity. When looking to invest or trade shares, only shares of publicly traded companies are available to trade on the stock market. So before buyers and sellers can trade or invest, a private company must first release its shares into the market. This is known as a primary market. Once the shares have been sold by the company, then they're free to be traded between market participants in what's known as the secondary market. What is a primary stock market? The primary market is where shares are listed onto a stock exchange by a private company. For the firm, the purpose of any primary market is to raise capital for expansion and strategic operations. For an investor or trader, a primary market gives them the opportunity to get in on the ground floor of a company and take advantage of any growth the firm might experience. Types of primary markets include initial public offerings, or IPOs. These are the first opportunity investors will have to buy shares of a private company. The process is underwritten by an investment bank who will issue shares, usually only to institutional investors, at a set price. Once the shares are listed, the company becomes a publicly traded firm. Rights issues or placings. These are the processes by which an already public company lists additional shares onto the market to raise further funds from existing shareholders or not. The equity generated by the sale of the stock in a primary market goes to the issuer, and the bank receives a fee for facilitating the sale. What is a secondary stock market? The secondary market is where existing shares are traded among investors. Once a company's stock has been sold in the primary market, the buyers are free to exchange them with other market participants and negotiate prices between themselves. The company will not receive any money from the secondary market, as any capital generated from the stock will go to the investor who is selling their holding. Investment banks and brokers act as intermediaries for the transaction, as most stock exchanges don't allow individual investors to directly trade into their order books. There is no limit to how many times a share can trade hands in the secondary market. Purposes of the stock market: capital and investment income. The stock market serves two very important purposes. The first is to provide capital to companies that they can use to fund and expand their businesses. If a company issues 1 million shares of stock that initially sells for $10 a share, then that provides the company with $10 million of capital that it can use to grow its business, minus whatever fees the company pays for an investment bank to manage the stock offering. By offering stock shares instead of borrowing the capital needed for expansion, the company avoids incurring debt and paying interest charges on that debt. The secondary purpose the stock market serves is to give investors, those who purchase stocks, the opportunity to share in the profits of publicly traded companies. Investors can profit from stock buying in one of two ways. Some stocks pay regular dividends, a given amount of money per share of stock someone owns. The other way investors can profit from buying stock is by selling their stock for a profit if the stock price increases from their purchase price. For example, if an investor buys a share of a company's stock at $10 a share, and the price of the stock subsequently rises to $15 a share, the investor can then realize a 50% profit on their investment by selling their shares. What moves the price of stocks? Stock prices are driven by the supply and demand for a company's shares. When the demand for shares rises and outstrips the supply in the market, caused by a higher volume of, prices will likely rise. When supply increases beyond demand, due to a higher number of sellers, it can depress a share's value. While each individual stock will have its own trajectory and be moved by unique fundamental factors, the stock market does broadly move together as a result of news, market sentiment, and macroeconomic data releases. Let's look at each factor in more detail. Fundamentals. These are the characteristics of a company and its financial data that are needed to understand its overall health. Many investors use earnings releases and a company's balance sheet to identify which of its fundamentals will impact their return, such as earnings per share, EPS, and price to earnings, PE, ratios. If a company announces strong fundamentals, revenue, profits, sales, and so on, then these metrics will rise, and the company's stock will be more appealing to investors. News and events can influence buying and selling decisions. Negative company news, earnings reports, political uncertainty, and natural disasters will likely create selling pressure in the market, while positive news reinforces bullish sentiment. Macroeconomic factors such as inflation, interest rates, and economic data releases will all influence the outlook for the individual companies and the stock market in general. If the economic outlook is poor, investment often declines and share prices fall. Market sentiment refers to the general opinion on a stock or the stock market. These prevailing attitudes can arise based on a variety of factors, including fundamentals, news, and macroeconomic data, but can also be formed based on popular opinion and rumors. How to invest in the stock market. There are two different ways to take advantage of the stock market: investing and trading. When you invest in the stock market, you'll pay the full value of a share up front, taking ownership of the asset and profiting if the market rises or if dividends are paid. However, if you trade the stock market instead, you'll be able to profit from rising and falling share prices. When you trade shares, you're speculating on the underlying stock without taking ownership of the asset. Stock markets have been around longer than you think. Stocks trade has been carried out for a while now. They are considered a big part of the modern financial world, but the truth is that stock markets have been around since quite a while back. In their essence, i.e., a regulated marketplace where investments can be bought and sold, you can see stock markets exist in the form of trade agricultural debts in France as far back as the 11th century. The 16th century saw a more sophisticated debt market taking form in Belgium. In the 1600s, the first modern stock exchange took form in Amsterdam when the Dutch East India Company became the first publicly traded company. The company, in an effort to raise capital for themselves, sold stock to investors who would receive dividends. As a result, in 1611, the Amsterdam Stock Exchange came into existence. For many subsequent years, buying and selling of shares of the Dutch East India Company were pretty much the sole trading activity carried out on the exchange. October is the most volatile month. There is a myth surrounding October in the stock market. There is even an effect called the October effect. People think that the stock market declines more during October than during all the other months. There were two big crashes in October: the Great Crash of 1929 and the crash of 1987 were both in October. But if we take the statistics over a long time, this effect is not significant. More bear markets were ending in October than starting in October. This data makes it more interesting, and these two crashes are old enough for most people to ignore them. Because of these points, fewer and fewer people believe in the October effect. However, according to data, October is the most volatile month in the stock market. There are more swings in the stock market during October than during any other month, so you need to be ready for some strong volatility during October. Do share with us in the comments if you know something interesting about the stock market. Thanks for watching.